Hello and welcome to Charting the Markets on Wednesday, the 21st of June 2023. Now, earlier this morning in the United Kingdom, we had CPI data out and it held steady at 8.7% in May, unchanged from the previous month 13-month low and above market expectations, though, of 8.4%. And basically rising prices for air travel, recreational and cultural goods and services and also second-hand cars were enough to offset slowing food and energy prices. And the problem for the Bank of England is that core inflation, which excludes volatile items such as energy, food, alcohol and tobacco, rose actually to 7.1%, the highest rate since March 1992. And this puts the Bank of England into a quandary because basically it means that, yes, it is likely to hike its rates at tomorrow's policy meeting for the 13th time. But the question is it going to hike rates by 25 basis points to 4.75% as was expected before we saw this morning's early CPI data for the UK, or whether maybe because of the data, the Bank of England will be forced to hike its rates by 50 basis points to really make sure that inflation doesn't remain sticky in the United Kingdom, but actually does start to come off. So this is really the big focal point for today's markets. And another one in the US this time is at 3 p.m. with the Fed Chairman Jerome Powell testifying to the House Select Committee. And basically, we'll have to see whether he will continue with the hawkish rhetoric the Fed has kept over the last few weeks. When last week, for example, we were told that there might still be 2 rate hikes in the pipeline with regards to the US Fed, which the financial markets actually discounted, and with equity markets rallying quite strongly at the back end of last week. But if we look at the FTSE 100, the daily chart, now we can see that the exact opposite is happening here, in that we've come off for 3 consecutive days. And this morning, on this higher than expected UK inflation data, we did slide down to 7,517 on this daily financial bet, and thereby fell through the red line here, the 200-day simple moving average at 7,551. So the last time this happened was back in late May, when we dropped down to 7,433. And basically what it means is if we were to fall through today's low at 7,517, then that May low may once again be targeted. So perhaps further downside in store for the FTSE 100 now that we've fallen through this dotted line here, which is the June current uptrend line, which has been breached, which now, because of inverse polarity, should act as a resistance area around 7,632 going forward. But basically, the fact that last week we failed at 7,688, which was right within the mid-May low and the early June highs between 7,655 and 79. So right within this key resistance area. Because we failed there, because we formed what is considered to be an ABC correction in terms of Elliott waves, and because we've fallen through this short-term uptrend line, the odds are now greater that the FTSE is likely to fall further rather than it holding once more and then regaining its strength. And basically the bulls could only be back in control on this daily chart if we were to manage to rise above 7,688. So provided we stay below there, further downside is likely to be seen with regards to the technical outlook for the FTSE 100. Now in Germany, the picture is quite similar in that the DAX 40 made a new all-time record high last week at 16,428 on this daily financial bet, which was marginally above the high seen in May at 16,333. So we had the market going up. But if you look at the relative strength index here, you can see that the high, which coincides with last week's high, is below that, which coincides with the May high. And when the RSI is pointing down whilst the market's making a new high, this is called negative divergence. And in about 70% of cases, it does lead to at least a short-term correction against the major trend, in this case, against the uptrend. And this is what we've seen over the last 3 days. We have come off quite sharply. We've fallen through the current May to June uptrend line, which, because of inverse polarity, once again, could act as resistance going forward around 16,244. But what I'm saying here is, provided we stay below 16,428, a further correction is likely to be seen and could take us back down again towards the orange line here, the 55-day simple moving average at 15,941, and also the 8th of June low around 15,886. So short-term downside more likely than upside with regards to the DAX 40 as investors reassess the monetary policy of not just the European Central Bank and the Bank of England, but also the US Fed, which is obviously very important. Now, with regards to the longer term trend, the medium term and long term uptrends, we would have to fall through the May and the early and late May and early June lows here, basically going down to 15,625. If that level were to be taken out, then a major top could be formed. But unless that is the case, this should just be another short-term correction in a medium-term uptrend. Moving on to the US markets, and here's the story is quite similar. You can see that we accelerated to the upside last week as investors didn't really believe the hawkish stance by the Fed and expected rates to perhaps already have peaked in the US. And now they're sort of trailing off very slowly, have taken us back down through the June uptrend line, and we'll have to see with regards to Jerome Powell's testimony to the US Congress today whether he will reinforce the hawkish stance and whether this time round the investors and traders will actually believe him, in which case the S&P 500 could fall further. And for a minor top to be formed, it would have to fall through last Thursday's low at 4,348, in which case we could then slide back down again towards the 4,300 zone. So short term, a negative bias likely to be seen here in the S&P 500 as well. Over the last few days, the US dollar has managed to regain some of its recent losses, and you can see this here on the daily financial bet of euro-dollar, which had previously risen very strongly as the European Central Bank kept hiking its interest rates to 3.5%, whereas the Fed paused and didn't hike its rates at its June FOMC meeting. And you can see here we rallied to 109.70, which was a 5-week high. But since then, we've drifted lower again on this rising US dollar and approached the red line, the orange line here, the 55-day simple moving average 108.84. Now we're just range trading in a low volatility range above this level ahead of Jerome Powell's testimony to the House Select Committee in the US, and basically we'll see whether the Fed chair at that committee meeting will today and tomorrow reiterate the Fed's hawkish stance and whether investors will this time around believe him or not. If they do, then it is likely that the US dollar will continue to rally, which would then push euro dollar back down again to below the orange line, the 55-day simple moving average, in which case we could perhaps retest the the mid-April low around 108.32 or so. So we'll have to see. But basically, if we were to rally further, we would need to take out 109.70 for this uptrend that we've made over the last couple of weeks to continue and to take us back up towards this week's high at 110.95. Moving on to Japan, we had the Bank of Japan minutes out for its last monetary meeting. Nothing much gleaned from it, but you can see here that we are now actually heading up again. This is incorrect. It should be 142 yen and 25 sen. And this is the high seen yesterday, which once again we are aiming for. And if I zoom out onto a weekly chart, we can see that we have now risen above the November 2022 highs at 142.25 and are basically trading at levels last seen in November of 2022. And the next upside target for dollar yen, therefore, is the 145 area, as you can see here on this daily financial bet. There is good support along the May to June uptrend line, and this can currently be seen around 140 yen and 40 cents. So right now, further upside more likely than downside with regards to dollar yen. Moving on to the British pound, you can see here cable basically rallying to 128.48, a level last traded back in April of 2022 on that interest rate differential between the Bank of England, which is expected to hike its rates to 4.75%, and may actually, after today's much stronger than expected UK CPI data, so UK inflation data, may have to hike its rates to 5%. So despite that worry, the British pound seems to be coming off against the US dollar and is heading back down again towards the May high at 126.79, which should offer us pretty good support. If it were to be fallen through, there's another good support area between basically 125.46, the mid-April high, and 125.44, the early June high. So that would be a support for cable. But short term, it does look as if the currency pair has now topped out at 128.48 on this chart last Friday. Commodity markets have taken a hit, or some of them at least, such as gold, on that appreciating US dollar over the course of this week. But before we look at gold, I'd like to have a quick look at WTI, that is to say US crude oil. And you can see here that we've been struggling around the April to June downtrend line for the last 4 days or so, and haven't really made any headway. So just some sideways trading being seen as traders reassess the outlook for the demand for oil. And for the bulls to continue to push prices higher, we would have to take out yesterday's high at $72.36, in which case we would then probably retest the early May high at $73.82. And above there, we also have the early June high at $73.89. So that's the next upside target area, followed by $74.70, the May high. And that would need to be taken out for us to break out of the sideways trading range we've been trading in for nearly 6 weeks or so now, and for us to head back up again toward the 200-day simple moving average at $77.98. But right now we're just trading right within the middle of this sideways trading range, and we're struggling around the downtrend line. So it's not really clear in which direction the next few days will take us. But basically, if you take yesterday's highs and lows, so yesterday's high at $72.36 as breakout points for the ensuing uptrend, or yesterday's low at $69.77 as a breakout point to head back down again towards the May and June lows, then perhaps you can trade yesterday's levels as the breakout points either up or down on this chart. Now, I mentioned the price of gold earlier on, and we can see here that the appreciating US dollar is pushing the gold price down again. And you can see we're heading back down again towards this 2-month low at $1,925 per troy ounce, which we formed last Thursday. And we'll have to see whether we can hold there or not. If we don't, the next downside target for me is the mid-March low at well, actually, before the mid-March low, we have the late January low at $1,901. So it's basically around the psychological $1,900 mark. And as I said over the course of last week, for me, the odds of the price of gold falling further towards that $1,900 mark are greater than us holding here and returning to the upside. So for the bulls here to be back in control, we would not only have to take out the May to June downtrend line, which currently comes in around $1,957, but also the early June high, $1,983. And right now that doesn't look likely. As you can see here, we have further bearish candles taking us down towards last week's low. Now, last but not least, I'd like to look at Chicago wheat, and the price of Chicago wheat rallied very strongly last week to a 2-month high, and this occurred in line with corn and soybean futures also surging basically on worries about Midwestern dryness in the United States. And all three commodities saw a flurry of buying last week as traders positioned themselves ahead of the 3-day Juneteenth weekend. But we also had some follow through yesterday when the US markets came back from that long holiday. And basically today we are testing this key resistance area between $7.16 and $7.30, in which you can see here the December and 2022 and January 2023 lows, and also the March and April 2023 highs. And when you have a confluence of previous lows and highs on the daily chart, then that creates a resistance area, and in my opinion a pretty strong resistance area, where I expect the price of wheat to peter out, especially since it started losing upside momentum in the last few days. And if I am right, we would then have to see a bearish reversal before trading against the trend. So for example, something like we saw in April, where you start to have bearish candles taking us back down again. Because if we were to be incorrect, if that resistance area were to be overcome, if we were to rise above $7.31, then the next upside target would be the red line here, the 200-day simple moving average at $7.53. But I wouldn't be surprised if we were to be capped by this key resistance area with regards to the price of wheat. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is AxelR_IG.